Hey listeners, today we had on Shayon Sengupta, investment partner at Multicoin Capital. Multicoin is an investor in the Solana infrastructure shop Jito, and Shayon recently put out a lengthy report about his valuation framework for the JTO token. We get into some fun nuances around whether JTO should be valued based on Jito's revenue and whether Jito is a centralizing force on Solana. Although Shayon is an investment partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. Let's dive in. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today by Shayon Sengupta, investment partner at Multicoin Capital. Shayon, thanks for coming on the show.
Thanks for having me, Jack. Excited to be here.
It's been funny. I feel like we're like running the multi-coin gauntlet lately. We had Tushar and Kyle in the past couple months, and now you. So I don't know how many other partners there are, but we're just speed running the multi-coin team, I guess.
We'll make it happen. Let's run it back turbo. Let's get doubles on pretty soon.
Yeah. Okay, well, Shayon, the reason we're having you on is because you recently wrote an asset report for Jito's JTO token that was a good read and just, I think, got into some broader questions of where the Solana network is headed. Multicoin, obviously a Jito investor, so you do have JTO bags. There's your disclosure at the top of the episode. But yeah, I kind of want to just dive into this report and some of your more general takes on JTO and Jito. Let's maybe start with just the place the report ends. You create like a valuation framework for JTO. Walk me through briefly how you arrived at that number.
Yeah, so I think it's important to provide like a quick disclaimer on that valuation methodology. The dollar denominated value is probably not the right way to think about it. We are explicitly thinking about JTO's valuation in SOL terms. And so the dollar denominated numbers you see there are essentially for reference at current SOL prices. Really, the more important way to think about JTO, or at least the way we think about JTO, is as a percentage of Solana's total market cap. And we think of that as, the rationale for that is twofold. One is we are modeling this as some function of the fee streams that are due to Jito DAO as a result of all of the different lines of business that it operates, which we have segmented over the course of the report into things like the core fee capture that comes from tips that go through the network, the revenues that are due from the LST product, and any additional revenues that come from restaking services. And so when you think about JTO and the sort of quote unquote cash flows that are due to that business, they're all in SOL terms. And so we model it all as a function of SOL, as a result of that. And I'd say the second portion of that is, in the way that I segmented it out, we sort of left out the restaking revenues because that's a more emerging, it's a more emergent line of business, even though Jito Restaking and the tip router NCN in particular is, I believe, the most profitable or the highest cash flow generating, like restaking network that is in existence today. We didn't want to sort of overly model that one out, and so it's a function of the two components of the valuation, which is the total SOL denominated dues to the DAO from bundle tips and the total SOL denominated dues to the DAO from staking fees. I can break down what those individual formulas look like as well, but that's just the claim that you should be thinking of JTO, and we continue to think of JTO in SOL terms.
I'll just start honestly with my critique a little bit, is that it seems to me like you're valuing JTO based on like the idea that revenue to Jito is going to be reflected in the JTO price, but I don't necessarily see right now any reason why that would be true. Some fees flow to the Jito DAO, but to my understanding, that doesn't go to JTO holders. So there's no direct connection currently between Jito's tip revenue and so forth and the JTO token. And a lot of this is sort of forward looking, right? It's based on expectations of what the Jito DAO may do for the token.
Yeah. Excellent point. I think it's always funny when I have like, people in hedge funds and traditional equity backgrounds coming looking at crypto and saying, why does this thing trade at 5x earnings? Why does this thing trade at 50,000x earnings? Like, there's obviously a huge amount of dispersion in the markets around whether things should be treated as a basis of fundamentals and how mechanically the fees get accrued to the token itself versus what's mimetic value. I think our general framing is that as capital markets mature, you end up in a stage where revenues are going to matter, right? Like, obviously, if flows are entirely vibes or mimetics based for too long, we end up with a small pool here. And as a result of that, our general expectation is, and through some of the some of the changing policy dynamics that are happening in the US, that more teams are going to find ways to directly have the revenues flow to the token, whether it's in the form of buybacks or distribution or lock liquidity or whatever the mechanic is. We generally think that's going to happen. If you look at the Jito governance forums, I believe it was JIP 13, or I can't quite remember the number. There's already active discussion from one of the members of the foundation to figure out how we can find a way for the treasury or the reserves of the DAO to essentially backstop the token in a way that's more explicit or more tactical. And I think some of the ideas that look akin to a burn, and you obviously start with smaller numbers and then you eventually end up with larger ones. And I think balance sheet management is a really important function for all these networks, and so you have to be sort of delicate with how you handle that. But I do think that where we stand today, the path is pretty clear in that direction. And so obviously we're doing some forward projections here, but that's my expectation of what we have to do as investors.
Let's talk a little bit about the buyback or buy and burn proposals for the JTO DAO, because this week, I believe it was Masari put out a report kind of arguing that token buybacks, to my understanding of their argument, are just poor capital allocation because the DAO ends up just acquiring these tokens at like poor prices because they may be buying in a moment of euphoria or something. And, essentially like the treasury funds would be better spent on, building up a war chest so you can spend during a pullback, or investing in innovation or something like this. So I don't know, I don't know if you looked at this post at all, but just in general, what are your thoughts on buybacks as just a use of treasury funds?
Yeah, I mean, I think there's no silver bullets for this stuff. Every business is clearly mechanically very different. Apple will distribute $1 trillion in cash to shareholders has done that over the course of the last decade because they clearly are cash heavy and can be in a position to do that and reinvest in growth in whatever form they choose to. Whereas, others may sort of just like retain everything on their balance sheet because they are more focused on growth and kind of getting to the position that Apple's in, right? And so I think that same principle that you see in equities markets applies in the same way to different networks. And I generally think different networks have different priorities, right? Like you can look at a deepened token, for instance, where we've sort of been vocal advocates of burn and mint equilibrium and sort of burning the vast majority of revenues that are due to the network, purely because price action and like reflexivity in capital markets matters a lot for scaling supply side resources and generally growing the network. And that may be true in at some period of time and may become less true over time. And so even that is not a hard rule. But generally, I think every different protocol will have different approaches based on how well they can allocate the resources. The vast majority of teams in crypto are obviously trading at substantially higher multiples to their revenues than you expect, and so you can ask the question: is a buyback really accomplishing much here, or is it doing something productive for the protocol? Should it be used in more sophisticated ways? I think there's been a lot of ink spilled on should you is a buyback and burn the right way? Is a buyback the right way? Is essentially providing two-sided liquidity and creating stronger liquidity and locking it up for longer periods of time the right mechanism? I don't think we take a a particularly strong view. Again, it's so case by case, and it's so dependent on where the network is. Jito is on, has been on track over the last year through a collection of all of its free streams to make almost 9 figures dollar denominated, and whatever that corresponds in SOL terms. That's a lot of cash due to the DAO. My guess is that a significant majority of that can provide significant support to capital markets, and so a buyback seems like it makes a lot of sense here. But obviously, having cash on balance sheet and doing bespoke incentives and using using those reserves in a way that can fuel internal growth for whatever initiatives they're doing obviously also makes sense. I think it's just a function of like what the priorities of the team are at any given time.
Yeah, it's a good point you raised there. It's like if you're doing 80 to 100 million in annualized revenue, hardware only costs so much, your engineers only cost so much, and what do you do with like just the rest of the money? I do think I tend to fall though on the side of like there's probably better ways you can invest these funds than in token buybacks. Like it seems like it's appealing to a certain Bitcoin brain instinct that you need to like reduce the supply, and that has a measurable impact on the token price. But much more important is innovation, like being relevant in the narrative of the day. Obviously, like whether crypto tokens trade on fundamentals is something of an open question, but I do tend to think that this idea that our buyback program is limiting the supply and therefore making the tokens more valuable is just, I don't think that plays out in the real world.
It sort of makes sense in what you just said, right? Like the Jito team, like they're small, they're cracked, they're clearly not like a huge organization that has a ton of requires the expenditure of a ton of resources. And so the question is like, do you just keep that? You just keep the earnings and have it there for a rainy day, or do you find ways to support capital markets to potentially acquire more power or more influence to do the kinds of things that you want to do as part of the network? I generally trust the capital allocation decisions that come from the folks over at Foundation and Labs. I generally think they'll find, given where they see their priorities, where they see their general roadmap, to be in line with like they'll obviously have the reserves to fund those things. And the question is like, what do you do with the surplus? And if you feel at a time that this surplus can be more effectively put to use in capital markets, whether it's in the form of a buyback and burn, or in the form of a buyback or protocol owned liquidity, or some sort of dividend construction. I don't know where we're at on the legal statute of that. But I think some sort of signaling to token holders matters a lot in the long term, right? Like people want to know that there is some baseline fundamental value that they are opting into as a, if capital is an expression of preference, right? Like they are saying that like, this is where I want to park my dollars or SOL or whatever it is. And I believe that there is a fundamental floor to this thing that is emergent from what this network creates in terms of positive value for the world, right? And I think having that in place and being able to go to token holders and say that there's something that's backstopping this thing. This price isn't completely vibes, right? Like if you want to trade vibes, you go to Pump, and that's great. That's awesome. I think that should exist. But I think having something there that tightens that link between the revenues that flow into this wallet or this set of wallets and what the token holders are due is just generally positive signaling. And I think we're going to see a lot of that. Like the Met is definitely going to shift towards that.
And I think tightening that link, in my mind, the most direct way to make that happen is through revenue distribution to JTO holders. Now, the thing that gives me pause about that, I guess maybe regulatory, well, not regulatory concerns aside, there are regulatory concerns, but also you think about Uniswap, which released the Uni token years ago, and ever since it's been this constant will they won't they drama about the fee switch. And where we stand today, there's still no fee distribution to Uni holders. And so the precedent of maybe the largest predecessor to Jito on Ethereum has been that it hasn't been able to make the fee switch happen. And there's a lot of interest that go different ways with turning that fee switch on. So do you have thoughts about that comparison? And can Jito accomplish a fee switch maybe where Uniswap failed?
Yeah, I think we've spilled a lot of ink on this. I think the blog post that I'm gonna like base a lot of my argument here on is one that Spencer and Kyle wrote a few years ago called "Protocols Don't Capture Value, DAOs Manage Risk." And I'd say the one sentence summary of that argument is if a protocol is stateless, or if it's not managing risk on behalf of its constituents, being able to capture value in a way that it doesn't get forked out is extremely difficult. And you sort of saw this in the uni sushi dynamics, where if you try to add a sort of unnecessary layer of fees on top of it, you will just get forked out. Like liquidity will not persist. And so Uniswap and Jito are like fundamentally different protocols in that they do not like one manages risk and one does not. In that Jito is handling a cohort of validators, it is handling a transaction ingestion and propagation pipeline, it is managing risk on behalf of stakers. There are 15 different components of risk in that system that are allowing it to keep defensible lines of revenue, whereas most fee pools on Uniswap are not constructed the same way, which is now, it's obviously a different argument that Uniswap Labs as an operator of front ends and through different products, the Uniswap X's of the world have found a way to generate revenues. But you could make the argument that those things are not necessarily properties of the protocol, but properties of the lab co. And the core AMM protocol is inherently not one that is able to defensively capture values. And so you could make the argument that the reason they haven't been able to do that is because the core protocol is not generating money, right? Whereas the things that manage risk and manage state in that form, money markets, derivative protocols, block space auction bundled with LSD configurations. I'd say the more apt comparison is probably Lido, because Lido is operating in a similar, is at least structurally similar from a mechanism perspective to Jito, in that you're operating a stake pool, you are obviously charging a spread on the total earnings, and both stakers and validators are happy to part with that spread and have been happy to do that for quite some time. My understanding is that Lido does not currently distribute those revenues back, but like I do think that at some point in the future, assuming a more clear regulatory posture, there will be a line of sight for token holders to see those revenues. And at least I hope to live in that world where that is an option and that's a thing that people do. But I think the important thing to consider is like who has a claim over the revenues? Is it the DAO or is it the lab co? And maybe that shifts back and forth. It's certainly different for different deepen tokens. It's certainly different for certain other protocols, and this configuration will change. But I think the question of like who has claim over the revenue and how durable are those revenues matters a lot. And so I think the Uni-Jito comparison for that reason is maybe a little bit off, but yeah.
I would think there's also optically some reason to want to shift the revenue to the Jito DAO because Uniswap is an app on Ethereum. Jito is like a core infrastructure provider on Solana. So it's not necessarily a good look if the labs entity for Jito is taking in this huge amount of ARR as like just a group of dudes. But maybe if you're sending it to a more decentralized entity that more people can get exposure to or something, there's actually just like a better optics play there as well.
I think it's just like what happens on the path towards progressive decentralization, right? It's like Jito Labs was the entity that made the core block space auction protocol, like the first validator client, everything that was built around ThreadStream and the ancillary pieces of infrastructure that actually supported the transaction ingestion and processing that was built. And for quite some time, they were a services provider in the early days to both the validators and the users of the network, and sort of the front ends and the RPCs that are using that infrastructure. But over time, the goal is like Jito at a stage where 10% of the stake-weighted Solana network is using the client is very different from the one where 95% of the Solana the network is using the client. And so again, it's very different when there's like 1 million SOL staked in the Jito SOL pool versus 15 million Jito SOL staked in the Jito SOL pool. There are phases in which, as your product becomes more and more ingrained in the network and used, and you have contributions from different places, and are no longer sort of the central party that is responsible for the development and the adoption of the protocol, that you eventually shift things out. And you're obviously seeing that in the fee dynamics, right? There was a time when Jito Labs would take 5% of every bundle tip. Now 3% of that is going directly to the DAO, 30 bips of which is going to the restaking vaults. And I think the gradual progression for that over time is for the bulk of that to move there. In fact, that's how we model it in our bull and in our base and bull case assumptions is the bulk of both the notional like absolute fee amount and the share of that is due to the DAO is trending upwards over time, and that's very much the direction we see it going in.
Mm-hmm. And that is an assumption. That
is an assumption. Absolutely, that is an assumption. Yes.
My case here. So let's get into the tech a little bit, because I do think in the Solana world and in the kind of media ecosystem I'm in, we can say some things so much that they become cliche. And one of those is we talk about Solana REV all the time, and Jito tips from MEV are lumped into that. So people have this vague sense that MEV tips create value for the Solana protocol. But one thing I enjoyed in reading your valuation report was you just give a really simple explanation of how Jito basically creates this off-chain block space auction. And without that, Solana leaders would basically not realize some gains from MEV. So can you just walk through a little bit, like when we talk about these Jito MEV tips, what do we really mean? And what is Jito providing to Solana's value accrual through that?
Yeah. I think maybe a good place to start is just like why, like what REV actually means and what MEV or like what we canonically define as MEV within a set of that is important. Like my like super like left brain view of REV is just like, what is the demand for block space on this environment? Like why do people want to interact on this piece of shared state? And I think the total sum of that, obviously, L1 tokens are not all constantly trading on some multiple of REV, but I think the end state of the world is that they should be. Like the only argument for why these things should be valuable, and we've sort of spoken and written extensively about this, is that the total sum of fees that users are paying for the right to transact on this block space is what gives value to the network. Right now, the question is like, what is the form factor for those fees? Like what are each of those fees doing? Base fees are obviously very different from priority fees, are obviously very different from MEV tips. The one line summary of what Jito is essentially providing to both users and validators on the network is a more performant network, and more performant based on basically two dimensions. The first is probability of transaction inclusion, which is, and we can go into the mechanics of how Solana's scheduled and the specific dynamics around how transactions move from originator to the leader can create opportunities where going through the traditional base fee plus priority fee mechanic is suboptimal for inclusion as compared to going through an off-chain block space auction that like reduces load on the network. But essentially the first job to be done is providing a stronger guarantee around transaction inclusion. And then I'd say the second is a stronger guarantee around transaction ordering, which is if there are a set of transactions that really need to be executed in some specific sequence, and they actually do not work if they're not executed together. And you can think of liquidations in that view. You can think of backruns or arbs in that view. Being able to bundle the two transactions together in a way that you're able to actually produce the outcome that you want for the network is extremely important. And the protocol currently does not have a core way of doing that, right? And so the really simple takeaway is that by having the Jito block engine exist as a way to siphon this specific set of priority transactions, both in terms of inclusion and in terms of like how they should be structured and ordered together within the block, you're essentially reducing a lot of the negative externalities that come from the core incentives of participants in the network when there is demand for when there's like a lot of demand for block space, which leads to sort of the kind of spam events you've seen where the network theoretically falls over when there's too many transactions. It's essentially a relief to the network by being able to route these transactions in this way, and then obviously sent to the validator through the dedicated kind of portion of the block that Jito is building. Look, the market structure around this is going to mature over time. The validator client is obviously improving. There's going to be more validator clients. The scheduler looks different all the time. We're doing things in networking. And so this is a dynamic game. I don't want to suggest that like Jito's current construction is like a holy grail or an end all be all for transaction processing. But historically, and that's sort of what our view has been, it has provided this, massive relief to the network, and frankly just helped it stay upright. And you can sort of see what happens to the network in times when there's like a ton of demand for block space, and how Jito sort of routes the fees in those ways. Or at times when Jito is, for whatever reason, having performance issues. There was a 3-hour period sometime in the last quarter that happened, and you can see what happened to priority fee spikes. And so our view of what Jito is just this like balancing force for the network that's helping it stay upright and essentially just deliver stronger guarantees for transaction execution and inclusion for validators, and obviously like more earnings as a result of the service that's being provided there.
Yeah, this was like a number of months ago that this happened, but Jito went down under high demand, and you saw that priority fees spiked, and sort of the takeaway was that Jito artificially lowers the median fee on Solana because people are willing to pay a little more for, like you said, basically the guarantee that a transaction will be included.
Sorry to interrupt, but yeah, priority fees skyrocketed, and blocks were generally less backed. Like I think that's sort of the other important takeaway from it was like they were, I think like every block was about 50% lower because just the whole network was was just like moving transactions around from leaders was just substantially worse, and priority fees jumped up substantially, but the inclusion rate went down, which means that having a dedicated lane to process priority transactions in this way is doing that. You're doing fee segregation, and sort of this is how being able to express preferences in that market structure for transaction inclusion, being able to go to the network and say, I need this to happen right now, and having a stronger guarantee that I can make that happen right now matters, and people are willing to pay for that. And that's all MEV is in this context, right? I think there is that, and that's sort of broadly how we're defining it. Like there's a lot of ink spilled on like, is MEV good? Is MEV bad? I don't want to rehash all those arguments. I think generally when I think about MEV, I just think about it as like demand for priority block space. And there's nothing good or bad about that. People can use it for bad things. People can use it for good things. But it's an inherent property of nature. And you need systems to like use that correctly, because otherwise you have the network falling over.
Yeah, and transaction inclusion is important, I think, for institutional adoption, which is everyone's like favorite topic right now. But institutions aren't going to want to deal with the kind of uncertainty around, could I be locked out of the network during a period of high demand? So it's not like the sexiest property, but it's an important one. I'm curious, just in terms of that first function of Jito, of helping with guarantees that you can like land a transaction on chain through this block space auction. Are there other routes or other ways that teams could build this that you think about as an investor? I'm thinking about like pre-confirmations on Ethereum, which sort of provide a similar thing. What's to stop a team from just going to validators and creating some piece of infrastructure that could do something like pre-confirmations and then sort of reducing the value that Jito offers to Solana in doing so?
Yeah, and I think this is interesting because you're already seeing some version of this behavior, which is like not all validators operate the same way, right? Like you can take the core, Agave client and run it on a box, but you will not be as performant as a validator that maybe on like the spectrum of like improvements you can do. Like maybe running just the core vanilla client is here, and then you have running that client with Jito is here, and then you have things like dedicated scheduling and transaction processing here, and maybe you have specific private order flow deals, which is like a thing that is happening in the world, like is much more profitable. So there's nothing stopping anyone in the world right now from processing transactions or making more finding different ways or more unique ways of inclusion if you have the order flow, right? Like the validators are all running their own mechanism. The thing that Jito does in this whole supply chain and is sort of like the source of where I think the staying power comes from for its product is just standardization, which is like I can be, take whatever meme coin wallet front end, right? I can take all my order flow and I can send it to some set of RPC providers, and I can have a deal with them to say, hey, look, if you can execute these transactions, I don't care how you route it, but if you can tell me that you can get these in this way, let's construct some off-chain. We'll construct some deal in order to make that happen. And there are reports of this type of activity happening in the past. But the problem with that is like you don't have all the stake on the network on the same system, right? You're inherently, with everything that we talk about in transaction inclusion, you're always giving probabilistic guarantees. Nothing is deterministic in these systems. But the way you increase probabilities is by having more of the network aligned on the same system, as opposed to fragmenting it across 10 different systems. And you can create separate transaction lanes, and look, there are people building sort of like leveraging priority ports and using different pieces of arriving at the same conclusion. But the thing that the thing that creates positive externalities in this whole pipeline is just having standards, just having most of the stakes saying like, all right, this is the market, this is what we're going to do, and we're going to operate on the same standard so that we can get a higher rate of transaction inclusion. So which is to say, like, look, I can't speak to the specifics of pre-confirmations or that structure, but you are always inherently starting from a point where you have to build a standard again. And that's why, like, smaller like deals for private order flow or new constructions have the same code start problem that is just harder to deal with. When 94, I think the number is somewhere around 95% of the Solana network is already bought into the standard and in acknowledgement that like operating transaction processing in this way, where you have a dedicated block space auction on the side and you carve out a small piece of the block for it, is working. I think that will lead to the more, like that is inherently the more competitive market for that inclusion. And that comes from just being the standard.
I think when you look at Jito, I don't have their ARR in front of me, but I don't know. They made something like 100 million in the last year, maybe a little under that. That's not going to last forever. And there's going to be competitors that try to come and do something similar because it's a great money-making opportunity. A recent example is Jupiter for a long time was really just the best DEX aggregator on Solana. It was the best place to do swaps. You got the best prices. There's now a new meta DEX aggregator, so-called, called Titan, that is in like a private beta. And I'm not going to get into it too much because some people have been arguing to me that it's not actually better than Jupiter and so forth. But basically, like, the TLDR is you're now seeing a credible competitor that claims that it can beat Jupiter 80% of the time in price. And that happened because the incentives around, like, Jupiter had this great money making opportunity, and they're not going to go on forever unchallenged. So I would think that the most likely outcome is that natural competitors emerge to Jito over time. So I think it becomes a moot point in the long run.
That's the thing that I say. Is something that I say to like portfolio companies is like, if you leave $1 on the ground in crypto, someone will pick it up before you realize you've dropped it. Like Jupiter's aggregator API was an exceptional product. The second they tried to put a fee on that, like this is exactly the point that we had with Uniswap, is like, if you don't deserve the fees, someone will come and take them from you, right? Like it's you immediately saw competition as soon as someone tried to extract a slightly harder end, and that's why these systems are good. Like you have permissionless capitalism, right? Like if someone can provide a comparable product to Jito, I think everyone welcomes that. I think the network welcomes that. I think like we candidly, like we have a Jito position, but we also have a Solana position. We want both of those things to do really well, right? And so if someone is providing a better competitive service and like compressing margins by all means, I think that should be encouraged and welcome. But it should be not for the purposes of like, we want to. I think some of the things that we've seen, we can go into specific names if you want to, but like some of the approaches that we've seen in the past have been less net accretive in terms of like, creating positive externalities on the network by building more performant infrastructure or some, economic or mechanical, differentiation for that whole transaction ingestion pipeline, rather than just like, all right, we're gonna create basically the same product without meaningful improvements. I think those attempts are like pretty much cooked. I don't think they end up getting to the state of dominance that you need. But yeah, like it's just a thing that happens, right? And there will be competition. Jito will have to evolve in order to face the competition, or the competition will win. And yeah.
Speaking of competition, maybe Jito, I think one of the most centralized aspects of Jito, perhaps, or centralizing aspects, is that its client is run by 94% of the Solana network, somewhere 95%, something like that, which is, a strong critique towards just Solana's centralization in general, is that there's not really a second widely used Solana client. That may change soon with Firedancer, the Jump developed very performant client, looking like it's on mainnet in non-voting mode right now. Now, one of the things that was holding back Frankendancer, which is the like halfway to Firedancer client that is in existence and in full voting mode, is that there's no MEV capture ability with Frankendancer. Now, something that was revealed in the GitHub code recently is that Jito bundles were added to Frankendancer. So I'm just curious to have you walk me through a little bit, because I think you touched on this in the piece, but how do like Jito bundles and Jito's MEV modifications play in with Firedancer, and what would it look like to, I guess, integrate Jito's tech into the Firedancer client?
Yeah. So like as you know, the vast majority of the network today is running the Agave client, the canonical, like the original Solana Labs clients, and they've been updated now through the teams at Anza. And the core product that we can sort of ascribe as Jito's product for the validator is, a set of modifications to that client that essentially link it to the Jito block engine, which is where the parallel block space auction is occurring. And so when people talk about the central dynamics, I would almost say it's not necessarily the client itself, because it's like just like the same software with modifications, but it is the block engine, right? As like a centralizing vector, and I think the way that's going to evolve over time is we'll see what happens there, but like that's the common criticism. What I'd say is that in a world where there are multiple clients, which is like most likely going to be the world we're living in, if at this time next year, as the network slowly starts to onboard Firedancer, I think what you're accomplishing through Firedancer is obviously substantially higher, the core promise of increased bandwidth and reduced latency. But the actual mechanics around transaction inclusion are not really going to change. Like you will need to have priority, even if the net throughput or the size of the blocks continues to increase, the if you believe the Jevons paradox, arguments of the world, where you increase the size of the pipe and more water starts flowing through the pipe, there will always need to be segregated lanes for prioritization. And I very much expect to see a world where you will continue to need to run some system that segregates transactions on the basis of inclusion and ordering in the way that you see them today, even if one set of the network is running a different client and more performant than the other. I really don't have a strong view of how that transition occurs, which is, do validators start running Firedancer on, does it get to 20% of active stake? Does it get to 40? Does it get to 50 by this time this year? What does the world look like when half the network is running one client, half the network is running another client? There's obviously a ton of, there's engineering things that are way too big brain for me to actually understand on that mechanism. But the thing that I do feel confident of is that you will need priority lanes for transaction, and Jito will provide that on both clients. And I could make the argument that having one portion of the block space auction, one portion of the block space that comes from this, central, currently central, but who knows what it looks like in the future, point as a portion of the ordering or the portion of the block space. Maybe there's an argument that sort of improves, that creates some degree of consistency, right, across both of these things. And so there's all kinds of interesting configurations where that could come together. But I think the core promise of you need dedicated block space is going to remain true whether your client is doing 1,000 TPS or 10,000 TPS, purely because demand should fill up.
I also wanted to chat about maybe the piece of the Jito slate that we haven't touched on much this conversation, which has been restaking. I'm curious just what your take is on the Jito restaking network. As you said, it doesn't factor into your valuation, I believe. And I think I almost have wonders myself if Jito overplayed its hand slightly on building out restaking, because it's the thing hasn't really taken off in the way people maybe expected on Ethereum, and who knows if Solana will be different. I'm tend to just kind of be bearish on the ability of restaking protocols to generate yield in general. So those are my priors, but I guess what do you make of Jito restaking with where things stand today?
We've been critics of the idea of this notion of economic security for quite some time, right? I don't have you don't have to look too far to find someone from the Multicoin saying economic security is a meme, right? And I think the vast majority of things we've seen in EVM land, which is really where that was sort of the birthplace of those set of ideas, there's really nothing of substance there, which is why it's surprising to me, or maybe not surprising, but it's notable to me that the first restaking network, or node consensus network, as it's called on Jito, which is the tip router contract, is producing more cash flow and is producing more economic value than any other restaking network that has existed. And just as an overview of how mechanically that works, the tip router contract is essentially what's doing the distribution once tips get sent to a certain address. Those tips have to be distributed to all the different parties that need to receive them, whether that's the Jito DAO or the stakers or anyone else. That process is a mechanical that needs to be called. It's a crank. And so that's something that you can automate using a restaking network without having a central point running that. I think that specific architecture of this is a certain set of mechanical operations that we rely on one person in the world to do. Can we automate that through some notion of, can we distribute that and then obviously slash bad actors and reward good actors for running that process correctly. I think that model of operation, or that model of a restaking network, is one that I can see having legs over time. And so, like, maybe one example of this is like, StakeNet is another product that does some version of this. I can totally see certain components of StakeNet becoming a node consensus network, and potentially taking some share of fees to like create more decentralization. Like, as you said, right? Like one of the things that is one of the criticisms of Jito as a network is like certain components may be centralized. Obviously, the direction over time is to decentralize those things. And when there are certain points of centralization, you could theoretically distribute them through NCNs. And that's very much the shape that the restaking networks have taken right now. And I think that idea has a lot of legs to it. And you could make the argument that like, how much are people willing to pay for it? Well, it's like, what is the price of decentralization for the network? For Jito, clearly the price of decentralization for tip router is 30 bips of all tips, right? And you could say, is that a good trade? I would say that's a good trade, right? And as long as that is true over time, the restaking networks will accrue value, but only in line with what the total pool of fees is that makes sense to decentralize.
Oh, that's an interesting point. Yeah, it's also worth noting that tip router became much more valuable, I suppose, after SIMD 96, which stopped burning half of Solana priority fees, was implemented. And while we wait for SIMD 123 to be implemented, which would have an in-protocol way to share priority fees, because basically there's relatively few ways currently for validators to share their priority fees with their stakers, but it's, I guess, a way to create a larger yield, staking yield for your stakers. So tip router right now is kind of in its glory days, it seems.
Yeah, we gotta bring our block rewards home. Like we gotta share them with stakers, and it's an important, like, it's a valuable piece of infrastructure, right? This is exactly what we're saying, right? It is providing something that the market wants, but the protocol is not able to offer correctly. As long as that is true, they'll be able to make money. The second that is not true, they will not.
Okay, I think maybe where I want to end, Shayon, is you argue that Jito is the primary beneficiary of Solana's growth. And I think there's like a line that's like, the ticker is JTO, So maybe to summarize a lot of what we've put out here today, like, why, in your view, does Jito benefit the most from the growth of the Solana network?
I think it comes back to where we fundamentally view the source of value for L1s. Our view is that MEV is the dominant source of value for an L1, right? Like, I think if you think about the proxy for how an L1 should be valued, I think it should be as a function of the MEV or the REV in that system over time. That's the only valuation methodology that I can, wrap my head around without resorting to things that, sound like store of value or ultrasound money or other concepts that don't really make sense and you can't really touch. Like, I think of these as businesses, and the cash flows around them are very explicitly the intent to transact on them, like the expression of the intent to transact on those chains. I think one thing that I highlight is that over the past quarter, or the past few quarters, Jito has dispensed. Now, obviously, those priority fees those fees are still going to validators, but they've dispensed more than half of the total amount of REV through the system, right? Like more than half the fees that are due to validators as an expression of that intent to transact on block space is going through Jito, right? And so what we generally see happening is if you take the prior that MEV is how you value L1s, and you view that Jito is essentially an expression of that MEV, or like as a economic system on top of the L1 that is routing that MEV between the user and the validator, it is disproportionately positioned to capture a ton of that value, and obviously the numbers today show that. We generally think value capture is going to move up the stack, And one of the dominant ways, one of the clearest expressions of that, right? Like we've heard this in the past of like apps will find a way to capture their own fees on top of those transaction fees, right? Like apps will capture more of the value over time. Well, in some lens, Jito is like the ultimate horizontal app on top of the L1, providing a service for everyone on top of it. I think if you assume Solana REV is going to increase, and you assume that demand for priority block space is going to increase, Jito is going to be the direct beneficiary of that. And this is not even a forward-looking statement. This is a backward-looking statement, because that has been the case. But if you assume that is going to continue, it will be in such a strong position of power and in such a strong position to capture the value that is emerging from the network. And so, yeah, that's really the argument. Is like, we think MEVs is how you value L1s, and Jito is the expression of that MEV in one capital asset.
Mm-hmm. Yeah, well, I saw this week that for the first week since early December, Solana got passed in total REV by Tron. So maybe Jito will migrate over there soon. I don't know.
I hope not.
Yeah. Well, I think we'll end it there. Shayon, it's been really fun getting to chat with you. Thanks for diving deep on Jito with us and taking the time to come on Lightspeed.
Yeah, thanks so much. Really enjoy the questions, and yeah, really appreciate the time.
Yeah, thank you everyone for listening. Please leave us a like or a 5-star rating, and share this show with a friend if you enjoyed it. Also, a reminder to subscribe to the daily Lightspeed newsletter, daily Solana news and analysis from yours truly. That's linked in the show notes. All right, that's all, everyone. We will see you again very soon.